Most people assume the biggest mistake that first-time buyers make is picking the wrong house. But nope, that's not even close. The biggest mistakes happen months before you ever step foot into a showing. And they're the kind of mistakes that silently can cost you thousands of dollars or blow up your deal 2 weeks before closing. I'm going to walk you through 5 of them today. And more importantly, I'm going to tell you exactly what to do instead, step by step, so you can avoid every single one. Hey, quick heads up. If you're serious about buying this year and you want to go over your personal game plan, there's a link in the description for a free strategy call. All right, let me get into it. Mistake number 1, and honestly, this is the one I see most often. People shop for houses before they know their actual numbers. And I'm not talking about checking Zillow and thinking, yeah, I could probably afford that. I'm talking about sitting down and figuring out 3 specific things: your credit score, your debt to income ratio, and your real monthly budget, not your most ideal month ever budget. Pull your credit score for free right now through your bank app or Credit Karma or freecreditreport.com. Write it down, then grab a piece of paper and add up every single monthly debt payment that you have. Get your car payment, student loans, credit card minimums, everything you can think of. Divide that by your gross monthly income. That's your income, by the way, before taxes. And that percentage is your DTI, your debt to income ratio. It's basically how lenders measure whether you can handle a mortgage on top of everything else that you're already paying. Actually, let me give you a quick example. Say you earn $6,000 a month before taxes and your debts add up to $1,800 a month. So $1,800 divided by 6,000 is 30%. That's a good spot. But if you've got $3,000 in monthly debts on that same income, that's 50%, and lenders may pump the brakes. This is the stuff you can calculate tonight just sitting on your couch. No lender is even needed yet. Just your bank statements and a calculator. Mistake number 2, thinking a pre-qualification is the same thing as a pre-approval. I had a client, let's call him Marcus, who came to me after losing out on 2 houses. He had a pre-qualification letter and thought he was good to go. Problem was, a pre-qualification is basically just a lender saying, yeah, based on what you told us, you could probably qualify. A lot of online lenders tend to issue these letters, so be very aware. Nobody actually checked his income docs. Nobody checked his tax returns. They didn't check anything. A pre-approval is different. That's where your lender pulls your credit, they verify your income, review your bank statements, and they give you a real letter that says you're actually approved up to a certain amount. In competitive markets, kind of like right now, sellers look at that letter, and if yours just says pre-qualified, your offer goes to the bottom of the pile. Here's what to do. Call a lender and specifically ask for a full pre-approval, not a pre-qualification. You'll need your last 2 pay stubs, your W-2s or tax returns from the past 2 years, and 2 months of bank statements. Get all that together before you call. It speeds everything up, and you can walk out of that conversation knowing exactly what you can afford. Now, here's something that gets really interesting, and this is the part that I would say a lot of people don't even really think about. The mistake number 3, not knowing what you actually qualify for beyond just a conventional loan. Most first-time buyers assume you need a massive pile of cash to buy a house. That's just not the reality anymore. There are conventional loans with as little as 3% down, FHA loans that go as low as 3.5% down. And if your credit score is 580 or higher, and depending on where you live, there are state and local down payment assistance programs. These are actual grants and low interest second loans that can cover some or all of your upfront costs. These programs go unused constantly because a lot of people don't even know to ask about them. But here's what to do. When you talk to your lender for that pre-approval, ask this exact question. What state and local assistance programs am I eligible for? Write that question down. Put it in your phone. Do not leave that conversation without asking it. Mistake number 4, and this one is just makes me crazy, is buying new furniture, financing a car, or opening new credit cards between getting pre-approved and closing on the house. Look, I cannot stress this enough. Your lender checks your credit again right before closing. If your debt went up, if you opened a new account, or if your credit score dropped even 20 points, your loan terms can change, or your pre-approval can get pulled. I've seen it happen. Someone bought a living room set on a store credit card 2 weeks before closing. True story. And that one purchase added enough to their monthly debt that their debt to income jumped over the limit and the deal almost fell apart. So the rule is simple. From the moment you get pre-approved until the day you get the keys, do not open any new credit card accounts. Do not finance anything. Do not make large purchases. And do not change jobs if you can help it. Pretend your finances are in a glass case. There's a sign on it that says, do not touch. All right, mistake number 5, and honestly, this might be the most important thing I would say in this whole entire video. Ignoring the true cost of owning a home. Your mortgage payment is not your only housing cost. You've also got property taxes, homeowner's insurance, possibly HOA fees, maintenance, and closing costs, which typically run 2 to 5% of the loan amount. On a $350,000 home, closing costs alone could be $7,000 to $17,000 on top of your down payment. So here's what I want you to do. Take whatever monthly mortgage payment you're comfortable with. Now add on roughly 25 to 30% on top of that. That gives you a much more realistic picture of your actual amount monthly housing cost. If that combined number stays under about 30% of your gross monthly income, you're in good shape. If it's pushing 40% or higher, you may want to look at a lower price range. Don't stretch yourself thin just because a bank says you can afford it. Remember, we're like emotional computers. Sometimes you just got to turn it off and turn it back on again. The excitement of buying your first home can override the math. So don't let it. Okay, so let me give you the quick 3-step plan you can start today. Step 1, check your credit score and calculate your DTI tonight. If your DTI is under 43%, that's a green light to start talking to a lender. If it's over 50%, spend the next 60 to 90 days paying down your highest balances and first, especially credit cards, since those update the fastest. Step 2, gather your last 2 pay stubs, 2 years of W-2s or tax returns, and 2 months of bank statements. Just put them all in one folder, like a digital or a physical folder, so that when you call a lender for a pre-approval, you're not scrambling. Step 3, when you sit down with that lender, ask about every program that you might qualify for. Down payment assistance, first-time homebuyer programs, all of it. Don't assume you already know. If you want to go over your personal game plan and figure out where exactly you stand, there's a link right below this video for a free strategy call. I'll take a look at your numbers with you and we'll map out a plan that actually makes sense for your situation. And honestly, even if you're 6 months away from being ready, that conversation can save you a ton of time and money down the road. If this helped you see the home buying process a little differently, please do 2 things. Number 1, click the link in that description to set up your free strategy call and hit that subscribe button because I'm putting out new videos every week breaking down exactly how to do this. This stuff works in plain English. Don't let one rough day make your buying decision for you. Get the numbers right. Follow steps. You'll be in way better shape than probably 90% of first-time buyers out there. I'll see you on the next one.